Starting with the yen, as I have alluded to in the intro right there, the levels that it is at now, we've reported multiple interventions. What really is the line in the sand for more of these interventions to happen? This is not the first time we've seen something like this happen when the yen crossed over, for example, the 150 mark against the dollar.
Yeah, well, thank you for having me. When it comes to the level of the yen that prompts intervention, it's not really a level. It's more unilateral moves that will cause those interventions. The authorities want to limit the carry trades, and carry trades are very much a function of volatility. Low vol equals more carry trade. So those interventions, you can see them as a way to inject volatility and deter carry trade. And that's all what they can really do in the short term.
So, Mathieu, I was also taking a look at some of your wider research, and you point out that the cushion supporting risk assets generally is still in place for the time being, but it's starting to fade. So under that argument that you point out, what risk assets are most prone to losing out?
Well, for the time being, the picture does remain quite positive in terms of liquidity. There is plenty, but at the margin, if we do see deterioration in carry trades because authorities are purposefully injecting some volatility in the market, we could see especially spread product suffering a little bit at the margin, since they are the main beneficiary of carry trade. So you're talking about high-yield bonds in the United States, investment-grade bonds, and so forth. But generally speaking, even this injection of volatility in the market is still quite minor compared to the amount of balance sheet space that still exists on the private sector, the amount of liquidity that still exists on the private sector balance sheet, and therefore the ability of those agents to take on risk and continue to bring the price of risk assets higher right now. And it's going to take much more action in the yen, for example, to end this.
Okay, let's shift a little bit to the United States and the US dollar. Its dominance so far, I would say, is still intact. You argue that we could see shifts away from the US dollar. How soon do you think we will be living in a world where the US dollar is not the dominant global currency? And who's set to benefit the most from that? Is it Europe? Is it China? Is it someone else?
Well, the reality is that the US dollar is set to remain the dominant currency for many decades here. However, there is subtlety in this situation, because the extent of the domination of the dollar in global capital market is exceptional and has been exceptional for the last 20 years. So what we are seeing here is more a deterioration at the margin. Namely, we expect currencies like the euro, but also the smaller currencies like the Australian dollar, the Canadian dollar, the Singaporean dollar, the Korean won, to be a beneficiary of a desire of authorities to diversify away from the dollar. But the dollar will still dominate in this context.
Okay, and Mathieu, let's talk a little bit about geopolitics, but also I'll bring in the Fed into the question. If the next market catalyst is not the Fed, but it's geopolitical tensions or trade tensions that are stemming out of whether it's the US, China, or other regions, what is the one trade or a particular trade or hedge that you would want to have in place today to avoid those tensions from disrupting?
Well, it really depends a little bit of the nature of the shock that we are talking about. When it comes to what's taking place in the Middle East, the hedge still remain and will be for a long time oil prices. However, when it comes to the trade tensions and those kinds of development, actually what we are seeing with the policy backdrop in the currency policy backdrop that is evolving in Japan, the pressure of on the Bank of Japan that is growing right now, at current level of valuation, and again, given the chances now that the Bank of Japan could change its tack, the yen could regain some of its shine as a safe asset that benefits in this context. Finally, I would add that gold is increasingly attractive once again. Structurally, it benefits from the diversification away from the dollar. And we at BCA anticipate a peak in real rates in the United States, which itself will be quite positive for gold prices. So gold as a geopolitical edge is starting to regain some of its shine.